What is up, everybody? Happy Monday morning, a beautiful Monday morning here in Atlanta, Georgia. My name is Sean Grapevine. I am the director of Agent Direct, the most, technology forward and innovative sales division in the mortgage industry. And I am joined here today, as with some Mondays, by a man who needs no introduction, but who will have to suffer through one anyway. He's a noted barbecue champion of the greater Tampa area. He's a multi time winner of only the most prestigious charity golf tournaments in the West Central Florida region. I'm jealous to say that he looks like what would happen if Rob Lowe and Tom Cruise ever had a baby. And he's been holding down the fort like a pre-Revolutionary War settler during a James Fenimore Cooper novel, such as Last of the Mohicans, in Austin Koenig's stead. I am proud to introduce to you Rob Pieklo. Welcome, Rob.
Wow. I think our time is up now after that. So, well, what an incredible introduction, Sean. Thank you.
Thank you. Do you like, have you ever seen Last of the Mohicans? Of course you
Yes. Yeah.
I'm old. It's one of the greatest movies of all time.
Yep.
So good. So good. Great score. Daniel Day-Lewis is fantastic in it. Really good.
Thank you for the research and digging deep on that one. I appreciate it.
Sure. I know I used up a lot of factoids, so I gotta research for the next. I guess we'll have Austin back next week, so I've got some time.
Exactly. So a slow data week, you need a long intro. I think that's a big
right.
deal.
That's right. So great segue. Let's dive right in and talk about last week's economic data. What happened, how it affected us, what we can expect going forward, and then let's take a look at this week. So, what did happen last week?
Yeah, so I'm listening. The numbers came in, our CPI numbers came in. We had a bunch of high volatility events that we expected, and some Fed speak, but everything was the same tone. I will say that looking at the numbers that got reported, we anticipated to see kind of a meltdown in interest rates, and we saw this slow melt up. So it's a little bit confusing. I think a lot of folks are in agreement that things are going to slow down. They're starting to see indicators of things slowing down, but this inflationary pressure and some things in the services side of the house that are keeping kind of inflationary pressures higher, and the fact that the Fed is going to raise 25 basis points most likely in May, it's kind of pushing rates up a tiny bit, which is a surprise. Like we keep hearing people talk about, like we heard Yellen speak about this kind of bank fiasco and the pressures and how lending is going to tighten a little bit, and that may cause a contraction in growth, and that may stop the Fed from continuing their increases, and it may have a bigger effect on slowing down the economy than the Fed can. So we heard all that, and yet here we are. We started Wednesday and Thursday with the 10-year at 337, 338, and now we're staring, I think, at like a 356 on the 10-year right now. We've seen this slow melt up in mortgage interest rates. And we kind of have the worst combination of the two things here, which is a slow data week. Kind of the trend's going to continue potentially to kind of have this slow melt up, and decent manufacturing came out today, kind of pushed that 10-year over that 350 range comfortably.
The market just loves the 10-year at 350. It doesn't matter, you get bad news, it goes up to 4 for a day or two and comes back down to 350. You get good news, inflation at 5%. Like I said this to Austin a couple weeks ago, like there's not very many numbers between 2 and 5. And I think I said that to you last week. Like it's good news. I mean, 5%, in a vacuum, 5% inflation is not really like a crisis, right? For almost any country. And it seems like like people are really, worked up over, things moving in the right direction, and what is nominally a pretty low inflation. I mean, it's not great, but it's not like, it's not hyperinflation by any means.
Listen, it's above the Fed's target. The Fed has done, they've used a lot of ammo to slow things down, and it hasn't occurred as they had or thought, and certainly not transitionary, right? or transitory. In that aspect of it, I think everyone's kind of just looking for some direction and looking to see some of the. Every time we think we're going down that path, we head down on the 10-year, and then all of a sudden something pops up and goes, well, wait a second, we may not be out of the woods just yet. And for the mortgage side of it, stability for MBS to start getting purchased. Like we need consistency. We need a place, because so many things determine the price of MBS in terms of where, like, rate move, prepayment speeds, MSR values. We talked about that a lot. All these things kind of go into play to investors to be confident that an MBS security is going to be good, if not better, in terms of a return than a treasury is. And we just want people to continue to put money into MBS and get some solid stability in this kind of premium market that we need. And it's not the best right now for the mortgage side, because these are one of those weird kind of occasions where I think Matthew Graham talks about it a little bit on Mortgage News Daily. And like, if you see it, like, this is that weird spot where people anticipate rates to be lower than they are, and the media is going to be presenting last week's data. So if they're going to use the Freddie Mac survey data, it's from last week. It's an average up until about Thursday, and they'll post that. So the media is going to show interest rates lower than what we're offering. So it's not the best combination right now. We just need to make sure we indicate and see what the remainder of this week does when it comes to rates, and if this trend's going to continue kind of creeping up, or if we're going to kind of hit a zone here where things stay stable and continue that downtrend we were hoping for.
Sure. Yeah. So like you said, not a lot in the news this week. Do we have? Are there any big pieces of news coming out this week?
Yeah, I mean, we have a lot of housing related data. We have some a global PMI is coming out on Friday. I think we have some Fed survey and some Fed presidents that are speaking this week. So we'll see what that tone looks like. And like I said, I'm hoping we just get some, just kind of static moves here. Just stay consistent and just kind of stay in this range. If we have to stay in a range, that's fine. We just don't want to see this kind of slow creeping up, and then that could potentially create opportunity for like a bigger move come in May. We know that there's a lot of stuff coming in May in terms of the Fed meetings, then the jobs report happens after the Fed meetings, and then that CPI data is going to be so important on May 10th that everyone keeps talking about. So we'll see what that looks like, and is that going to be the big drop that keeps rates moving or gets rates moving downward in a faster trend? We'll see. But now we're coming to the point where that's about 3 weeks away.
So assuming the Fed, stops, announces that they're going to stop, like we will see. It seems like maybe some easing in the rate markets, but with the Fed funds rate at 5%, to me it sounds unlikely that we're going to see this, like, that we should be putting our hopes in some sort of massive drops. Like what like best case scenario, inflation's at 4.3%. The Fed announces that they're not going to they're looking to slow down, and then they actually do. They stop hiking rates. I mean, doesn't that just mean that rates will stay where they are? Like, why would rates go down if nothing else really changes?
Yeah, I mean, it's going to be about output, and it's just going to be what growth looks like. So if there's going to be a slowdown, rates are going to have to come down, especially on the long end. What we're seeing is that this is like the longest time that I've seen that there's been this inversion in the yield curve. So you're seeing a 2-year and the 10-year, that spread, it was super wide. The 2-year was way ahead of the 10-year. And it got up to almost 100 basis points of difference, which we haven't seen that, at least in my era of watching it, and it's been that way. And then now we've tightened up a little bit. We're about 55 to 65 basis points in that spread, and that's like the telltale sign of a recession is coming. Like, that's what everybody uses. But now we've been in this spot for so long that it's kind of raising questions. And that 2-year, 10-year spread is something to kind of pay attention to right now. But we would see that long end, that 10-year side, start to come down drastically if they feel like there's going to be significant slowdown. You have to look at consumer debt. People are taking on a ton of debt right now, and that maybe is filling some of the gaps in some of these growth numbers that we're seeing. And then start thinking about like the costs of that debt. People forget, like, people are always like, oh, my rate's low, I'm going to go take a HELOC. Well, like, prime's 8. like the HELOC is at 8. Your credit card,
it's like a nice credit card.
Yeah. Well, then you have like a very, very nice credit card, and then you have like a credit card where people are taking more and more out on their credit cards right now. If you look at the data, and short-term loans and payday loans, if you start paying attention to these things, those are based off of prime. These are based off of short-term rates. those rates are really expensive. So your minimum payments are going up. Things are coming in. It's going to start to eat into their ability to spend in the future. Now, you getting a little bit of a lag. I think people are just borrowing more and still spending. That's just like the American way. But what we anticipate seeing is that these rates are going to have an impact. And then if banks start to tighten, meaning like, if you read the fine print of your HELOC, it says it in there that at any time the bank can just shut it off.
Right.
Right.
And it's like they always do it at the most inopportune time. Right. Yeah.
That's the time.
When a lot of people from 2008 can attest to that. If anybody's interested in, did I recommend this book already? I don't know. If anybody's interested in reading about, okay, so we know that interest rates in similar instruments at different maturities will eventually converge, right? The 2-year and the 10-year will eventually converge, and the 2-year will start offering lower rates than the 10-year. And if anybody's interested in reading a book about how that axiom almost led to the collapse of the American banking system, I think there's a book called The Rise and Fall of Long-Term Capital Management, who poured a ton of like leverage into that bet because it's small moves. So they poured a ton of leverage into it. And they said, well, they'll definitely converge. And the interest rates kept not converging and created about like several $1 trillion in loss and paper losses that they had to settle somehow, and almost brought down some of the biggest banks in the world. And this is like maybe the late 90s. Really, really interesting how the sort of smartest guys in the room yet again, placed a bet on a sure thing and almost, just absolutely rip the face off of the American economy. I don't remember that, but it is certainly a book worth reading, and also just like goes to show, we keep saying, hey, these rates are going to converge, rates are going to come down, but as loan officers, we only exist right now, and it's like rates are where they are. They're really not that bad, and there's still plenty of demand out there. I mean, we keep setting record lock weeks and months and quarters, and are on track to fund a record amount of loans, and we're not really hearing a lot of pushback in the trenches. Our loan officers, people aren't not buying houses because rates are too high. They're just ready to live with it. So rates going down will be great, but where they're at seems totally reasonable right now. And I'm sure you're on the secondary team and are seeing that as well, right? Like we're not getting
like I said, what matters is stability, and people want to be able to price, and that's it. So that's what we're looking for. We're looking for comfortable pricing. Yeah, some of the loans with maybe higher loan level pricing adjustments are a little bit difficult to price still because there's a lack of premium. But in terms of that, like solid tier borrower with good credit and a little bit lower LTVs, like those things are pricing aggressively right now when you look at spreads. Like we just have to look at stability, money kind of coming into to comfortably come into MBS, get the premiums up a little bit, and then kind of see this downward trend hopefully continue. And there's a magic number. Once we get into the 5s, you see a ton of buyer activity. Like once you get the opportunity into the 5s, you see that like it really spurs activity. So as we hover here in the low to mid 6s and get closer to the high 6s, you kind of see that start to diminish a little bit, and then once these moves come down and the media gets a hold of it, it seems like buyers come out of the woodwork. But we're still running into inventory issues. We're going to see a lot of data about housing this week. It's interesting to see, we're hearing bidding wars are back. We're seeing that in a lot of regions. There's just a lot of stuff happening in the market that kind of points to, buyers that have been sitting on the sidelines. It hasn't worked out. The crash isn't here. It's not imminent. It's not. This is something that
it just keeps not happening year after year after year after year.
And we talked about it on some of the Clubhouse shows we did, in 2020, 2021, and like eventually the housing crash guys are going to be right. But there's not much difference in being early or being wrong, right? Like you can lose a lot of money being early in that call, and we feel like we've been trying our best to communicate this out, regardless of what the media said, regardless of what the housing crash pundits have said, and like it has always worked out that if they had purchased yesterday, it was always better than purchasing it tomorrow, right? So that's the way that's always panned out. So there's no better time than the present to get buyers in.
All right, you guys heard it here first. No better time than the present. Last week we had the 1% Down program come out. Fantastic program, even better conversation starter. and a great opportunity for us as LOs to use our product optionality, not just to close more loans, but also to create more conversations, and also tertiary piece of action item we can take is using it to coach real estate agents on how they can produce more leads with it, right? Like what UWM did, produce more leads for them, and then when we go and advertise it, produce more leads and conversations for us, and we can trickle that down to agents as well. So the product optionality here at UMortgage is unparalleled. It's so great to have so many fantastic arrows in our quiver. Rob, any new products or lenders you're excited about in the next couple weeks?
Yeah, so we'll be announcing a couple new lenders that have joined our roster. We're going to be working through a ton of DPA programs, and we've been really trying to find a better process, to get lenders onboarded, get people to utilize them, and be knowledgeable about their products. So we've started our Friday lender spotlights with some of our lenders during our sales huddle. It's been really important. For us, we have to understand as a community, as a company, as people that are on the kind of ground floor out there talking to home buyers, like, this 1% program is just the beginning, right? These DPA programs are just the beginning. There is a clear, concise message coming from FHFA, who governs the GSEs, that affordable housing is the #1 initiative for government-sponsored entities. Like, this is it. More is going to be coming out. More lenders are going to get creative in finding ways to do this. You've seen it in their LLPAs. You've seen it in their grids. You've seen it. We are focusing in on getting those costs, to lend lower and lower for those borrowers that need it the most. So this is just the tip of the iceberg of that program. The GSEs have been very clear, very loud when dealing with some of the largest lending partners about their percentages of affordable housing programs that are out there. It's not enough. So they're going to be creating new programs, coming up with new ways to really drive down those costs for those borrowers. So anticipate more of that coming along, and seeing even more aggressive products along the DPA lines, and these forgivable grants like UWM just rolled out.
Sweet. I can't wait. That's going to be so helpful. And like I said, just a great, great way to give back to your community, and also to create great conversations. So we've got nice and long today. I appreciate your time here, Mr. Pieklo. You did an excellent job filling in for Austin. I'm sure we'll have you back on, in no time at all. And have a great rest of your week, Rob, and everyone else.
Thank you very much, Sean. Later.